Summary of One Up on Wall Street, Peter Lynch. Welcome back to the channel Wisgram, where you can get practical wisdom for money, investing, success, and more. In today's video, I'll be sharing the summary of One Up on Wall Street by Peter Lynch. But before we begin, please give this video a big thumbs up and don't forget to subscribe so that you wouldn't miss any of our new videos that will be uploaded every week. Now, let's get started. Who exactly is Peter Lynch? Well, he was the legendary mutual fund manager who took charge of the Magellan Fund at Fidelity USA from 1977 to 1990. Through his services, the average return on investments grew up to 29.2%, approximately $18 million to $14 billion, more than double the S&P 500 in the same period. The good news is the investment principles used in that success were revealed in his book, One Up on Wall Street. And in this video, I will be sharing the major key takeaways with you. Here are 5 of them. Number 1. Why the individual investor can beat the pros. According to Peter Lynch, the assumption that the amateur doesn't stand a chance against the might of Wall Street is wrong. The professional investor has far more disadvantages than the amateur. Here are a few of them. Size. A successful money manager will naturally attract a lot of money, but more money implies fewer opportunities. A $10 billion fund, for example, cannot invest in a market-capped $10 million company and expect the investment to have a significant impact on the fund's overall performance. They will lose your job if they lose the client's money. So they will play safe, being the sheep in the herds. Keep in mind that fund managers have their own agendas and that they too are employees with uncertain careers. There's a lot of explaining. Fund managers tend to spend about 25% of their time explaining why they made certain decisions to various stakeholders. Unfortunately, stocks aren't sympathetic enough to yield an extra 25% for this increased effort. Capital is dependent on clients. Asset fund managers invest other people's money. Therefore, they tend to pull their money out of the market during a downturn and put it back during a surge. However, this activity is exactly the opposite of what one should do. As a result, the manager has a lot of money to invest when everything is expensive and too little when everything is cheap. Number 2. If you like the store, chances are you'll love the stock. You have an advantage over Wall Street whether you're a bank teller, a milk tea fanatic, a professional musician, a technical writer, or just a person who loves pets. Why? You know a lot more about a particular industry than the typical person. The point is that everyone has useful information about publicly traded companies in their daily lives that Wall Street either doesn't know about or has to discover through hundreds of hours of market research. So, which publicly listed company products do you like and use? Number 3. The 6 categories of stock investments. The stock investments have 6 categories, and companies don't stay in the same category forever. Like McDonald's, the movement started from a fast grower to stalwart to an asset play and to a slow grower. The question is, why is it important to know these categories? Understanding the nature of the companies you own and the specific reasons for holding the stock is a vital consideration because, in that way, you'll have a better idea of what to expect from them. Here are the 6 categories of stock investments according to Peter Lynch. Slow growers. This business is usually huge and operates in a mature market. The company's growth is predicted to be in the low single digits of percentage. These are enormous, old businesses that were once fast-growing but have slowed due to various factors. In Lynch's words, they pooped out. Their market prices don't change much. Thus, they aren't very profitable in capital gain. However, they pay significant dividends, so they are suitable for low-risk investors who don't expect sky-high capital gains. Stalwarts. The stalwarts are in the middle. Under typical circumstances, these categories' earnings grow at a rate of 10 to 12% per year. If these companies achieve a sudden 30 to 50% gain, you want to sell them. Lynch likes to preserve certain stalwarts in his portfolio because they provide defensive protection during market downturns. He says, you know they won't go bankrupt, and soon enough, they will be reassessed, and their value will be restored. Fast growers. These are small, aggressive new businesses that are growing at a rate of 20% to 25% each year. If you're looking for 10 to 40 baggers, and possibly even more, this is the category to look at. Fast-growing companies may be a part of fast-growing industries, but Lynch prefers fast-growing companies in slow-growth industry. Walmart, The Gap, and Yum Brands Taco Bell were among the winning brands that learned to succeed in one place and then duplicate their formula. Cyclicals. These are businesses whose sales and profitability fluctuate according to the business cycle. In most cases, they create services and goods that the consumers will put off using during times of financial instability. The automobile industry can be a good example. People don't necessarily have to switch cars every 6 years, even if they prefer to. Turnarounds. The turnarounds are companies with declining earnings or problematic balance sheets. An interesting feature about this category is that their ups and downs aren't as closely tied to the market as the other categories. A profitable turnaround case is when a corporation has received a temporary bad reputation. These businesses have incurred significant losses or are on the verge of going bankrupt due to the unprofitable investments or a lack of funding but are working to recover. These are, however, extremely dangerous investments because businesses could go bankrupt at any time. Asset plays. Asset plays are situations in which the firm's value suggests that the market has missed out on something valuable that the company holds. These businesses typically have high-value assets such as real estate or stock in other businesses, patents, natural resources, subscribers, or even losses, as these are deductible from future earnings. Therefore, if you invest in an asset play firm that invests in productive enterprises or prime real estate, the company's worth will rise as well. That means you have a chance to enjoy huge capital gain when the market realizes the real value of the assets the company is holding. Number 4. 10 traits of the 10-bagger. A 10-bagger is the expression that Peter Lynch uses to describe a stock which has appreciated 10 times your purchase price. Here are 10 positive signs for a stock, regardless of it being an asset play or a fast grower. The company name is dull, or even better, ridiculous. Such companies tend to be overlooked. It does something dull. It does something disagreeable. Better yet, than doing something dull is to do something disagreeable. Institutions don't own it, and it's not followed by any analysts. Such companies haven't been discovered yet, which gives them an extra potential upside. It's depressing, like the Service Corporation International, a funeral home operator. The industry isn't growing. Growth industries attract too much interest from investors, leading to high prices and competitors. It's got a niche. The company is a niche firm controlling a market segment or that would be difficult for a competitor to enter. It has recurring revenues like subscriptions or something that is consumed so that the customers are forced to return for more. Insiders are buying, a positive sign that insiders feel particularly confident about the firm's prospects. The company is buying back shares. If a company has faith in itself, it should invest in itself. Lynch prefers share buybacks for dividends. Number 5. 5 traits of the reverse 10-bagger. Of course, there are also general traits that you don't want to see in any type of company that you are investing in. Here are the 5 traits of the reverse 10-bagger. It's in a hot industry. Everyone is looking for ways to get into the hot industries, and thus, competition is typically a bad omen for profits. It's the next something. Be aware when someone expresses that it's the next Amazon, the next Facebook, the next Google, or similar. Usually, it's not. It's diversifying profitable companies engaged in diversifying acquisitions. It's dependent on a single customer. Companies in which one customer accounts for 25% to 50% of their sales will lead to a weak bargaining position, and the company can be squeezed by this only customer. It's a whisper stock, meaning there are long shots, often thought of as being on the brink of doing something miraculous but hard to happen in reality. Peter Lynch offers a realistic method that can be tailored to the needs of a wide range of investors. Moreover, his books offer a wealth of practical information on what to look for in a company and how to assess the market as a whole. In what ways does this video affect your views and opinions about investing? Well, that's it for today. Thank you for watching and see you again soon in another one of our episodes. Once again, if you like this video, please give it a thumbs up and share it with your friends and family so that they can enjoy it as well. With that said, have a wonderful day everyone, and I'll see you in the next one.